Welcome back, traders. My name is Manuel Fonseca. Welcome to Smart Habits. In today's video, I'm gonna give you some examples of how to identify properly the liquidity. In a previous video, I have already explained the concept of liquidity and the theory about this. If you haven't got the chance to see it, I kindly suggest you to watch it before seeing these examples, and the video is in the first comment below.
So we're gonna start with equal highs and equal lows liquidity. Resting liquidity, that's how it's called. Now, the equal highs in a range or consolidation. Okay, remember in this case, we're referring a range not as an impulse, but as a consolidation, represents a buy side liquidity, while equal lows represent sell side liquidity. These levels attract retail stop losses, making them ideal liquidity pools for institutional sweeps. Okay, as we're doing all of this, as in a bullish example, I'm gonna show you, or I'm gonna focus on equal lows, which are the liquidity that we will find in a bullish trend, correct? So imagine that this is the market consolidating, as you may have seen several times, correct? And what it means is that, for example, sometimes when the price gets really, really slow, for us as a traders, retail traders, it's easy to identify basic patterns. And there is where most of the retail stop losses start accumulating. So imagine this. People start, first you see this high, which is normal for us. Then you see this lower high, and then you see the next. In this high, people start thinking this is a double top pattern, and this is a good idea to execute an order here. Perfect. So people put an order here as an example, correct? Here as an example, people put an order here, right? The price, as it is very smooth or move really slow, then you start getting confused, because then you see this low and this another low. So you say, oh, this is a double bottom pattern. So people start putting or betting, in this case, to put a buy limit, a buy order, a buy limit order, whatever, right? Because in a consolidation, there always will be, let's say, certain pressure from buyers and sellers. Okay, now people who are waiting for the pattern of the selling pattern, they will wait, see this reaction. People who were waiting for the bullish pattern will wait for this reaction. So you can see here is a triple bottom confirm, or a triple top pattern here. So this is easy to identify for most of us, and this is a trap or a liquidity trap, right? Because the prices start like consolidating or creating equal highs and equal lows. That's the name of the pattern, right? Now I'm showing you this in order for you not to fall on this trap, right? And recognize this type of patterns in the market, so you are not part of that liquidity taking. So now imagine that we as traders are here, and there are other, but as you, there are another million, 20 million, 60 million traders, retail traders watching the same stuff, right? So at the end, what institutions see here, it's a liquidity pool, right? And that's what you have listened to that concept before, the liquidity pool. And this is created because there's a lot of stop losses accumulated for 20 million, 40 million, I don't know, a lot of people, right, are putting orders here, even selling or even buying, right? So as traders, we should be more intelligent than that, correct? So what happened after this? So the equal highs or equal lows are not reversal signals by themselves, okay? They are liquidity magnets. They are just trap a lot of people or money here. An institution often manipulates these levels before delivering a real trend movement, right? So, for example, right, we are in this moment, and imagine we are in it that we are in a bullish trend. The price mostly have a movement, a radical movement towards, I mean, downwards, and then with the same candle, push up, right? Keep pushing up. Or sometimes I have seen this type of reactions. There is a news in the market with a huge candle. It takes the liquidity of the people who are buying here. So it takes all the stop losses, pushes down. So people who were thinking, oh, it's now the moment to sell, start selling. And then it reacts a order block or a point of interest, and then it keep pushing up. So takes the liquidity of the people who were buying in first stance here, then takes the liquidity of the money of the people who were buying here, and then it keep pushing up to continue with the real movement. So this is the pattern number one people often falls into, which is the equal highs and equal lows. So please bear that in mind. We're gonna see examples of this in a minute. All right. Next pattern of confirmation, it's called trend line liquidity. Or as you can also see or listen to, there's also names, no? And like channels or all this stuff. But look, this is what it is. Trend lines attract return traders who place stops below ascending trend lines or above descending trend lines. Institutions target these cluster stops, making trend lines one of the most consistent forms of liquidity. Okay, so if imagine that we are in a bullish trend as well, or again, right? I'm gonna give you a little bit more context. Let's draw more context. Like, let's imagine that here is a huge impulse like this. Perfect. So people start like seeing this type of patterns, and because they are back up with this trend line, bullish trend line, people start thinking, wow, um, there is a pattern of the three pattern candle, the three pattern, the three touch pattern, which is like if the price touches three times the same area, it means that the third time there will be a probable reaction, right? The first one is just made, no one expects this first reaction. The second one is made just for, okay, it's confirming that this is a strong area. So at the third movement or the third pivot point, it means that the price will have a real reaction, right? That unfortunately not always work that way, right? So people start placing orders right here because we're doing in a bullish example. That's why we're gonna put an example of a bullish trend line liquidity, okay, or diagonal liquidity. So how many of you have done this? I did it myself at the very beginning when I was learning these concepts, correct? So again, there are millions of people, traders, right, that are executing that exact spot right here or that pivot point because they're expecting for the price to do a correct movement here, right? So sometimes the price have a small reaction towards the direction we expected it would do, and then it will do the next. It will keep pushing down to take out us from these orders, right? So it takes our stop losses. Now people start changing their minds. They say, "Oh my gosh, probably this is not the pattern we were expecting. Probably it's a head and shoulder pattern, right? Because this is also other thing that we're watching in the market. So this is the head, this is the shoulder one, head and shoulder two, right? Head and shoulder pattern. So people start changing the way they think and say, okay, no, now it's time to sell. And people start executing selling orders. Let me wrap this. Selling orders here at the break of the as the pattern says. But remember that we are in a bullish trend, and what happened after that is that you are again trapped by the movement and the impulse, and you're out from the market, right? And this is another, let's say, trap that exists there. So trend lines are not meant for entries, but for monitoring where the institutions may take liquidity. The break is often manipulation, not a reversal. So this is what we just have explained in this short example. This break doesn't mean a change of direction in the market. It means most of the times a manipulation, or not just a manipulation. It's not manipulation. It's just like the market needs to be effective. So probably it took all the liquidity of these lows, reacting in that point of interest here, and then it keep pushing out, right? When you say, personally, this is my point of view, honestly, friends. When you say the market is being manipulated, right? I perceive that as a victimization way of seeing the market, while the market is just candles, numbers. So I mean, I think if you say that the market is, you're being manipulated by the market, puts you in a really victimized position as a trader, while you just need to be responsible. As simple as that. Sometimes even following the trading plan, it will take you out. And you should take this as it is, as a probability, because this is what is trading about probability, and also having a sample of that is profitable, period. Don't take that personal. You shouldn't take the market as personal, because then you start putting or what you are in the market, and the market is just portraying everything that you are, and it's a really introspective profession, I would say. But anyway, this is the thing. This is not manipulation. It's just the price being efficient, and this is the liquidity. Okay, how the liquidity works. That's it. And now let's go with the next pattern, which is called double tops or double bottoms, that are also liquidity traps. Okay, what is the difference between double bottoms, triple bottoms, and the previous one, which equal highs and equal lows? Equal highs and equal lows, they are mostly in a small range or a small area of the market, while the double tops or double bottoms could be bottoms or tops, right? That are, or highs or lows, that has certain, that are old in the market, let's say. Probably we can have as a reference point, for example, this bottom here is from a Friday, and this bottom is reacting on a Wednesday. So they are farther in distance, let's say. Perfect. But let's say the definition of a double top or double bottoms. So double tops, bottoms are not true reversals. They are liquidity traps where retail traders think market will reverse at the same level. But in reality, institutions accumulate orders above or below these levels. Okay? Again, we're in a bullish example, bullish trend, correct? Now, if you're in a bullish trend, you start thinking, or you have learned patterns to continuation, correct? Some of these patterns, and this is one of the most common ones, are the double bottom or double tops. Because we're in a bullish trend, we're gonna see examples of double bottoms, because it's the one who continuates with the direction of the market. Now, this also needs to deal with resistance levels and support levels. And people would say, okay, so this low will become or resist or support level, right? Or bottom. So the price entering this area, and again, you execute a bullish order, right? Because you're just following the main trend line, correct? Which is correct. You know the direction, and that's good. But it happens mostly like the previous pattern we saw. The price may have a small reaction towards the price. And again, this is the think in terms of liquidity. If you see a pattern that is very evident, trust me, my friend, there is another 20 million people watching the same pattern, executing with the same pattern, same thought, same knowledge, and they will put not the same amount of lots as you, but they would execute the order right there, right? And this is the thing. Um, there is there you could see that there is a huge liquidity pool here because there is not liquidity pool, it's just a lot of liquidity here. Many people are putting money here. And what happened after that? You already know that, my friends. The price has certain reaction as towards the price we think it will be. It pushes down, and the pattern of thinking is the same. You see this break of the structure, this liquidity taking, and then you start thinking, as the price has breaking the structure here, or take the liquidity of this low, it has already changed the trend. Now let's start selling because that's what we should do now, right? And people start putting in selling orders right here. And as we saw with the trend line example, it happens the same. The main trend line is bullish, so the price will react probably in a zone here, in an order block, or in an imbalance, and then with a really huge move, it will keep pushing up. How many of you have lived this situation? I think plenty, right? Like me, of course, because I have lived this many times, and it's a little bit painful because it's like, holy crap, I'm just using the information I thought is correct, but it's not being correct, and now I'm just like losing money, or at least losing trades. I'm finding nonsense in this profession, right? It happens, guys, it happens. But right, now it won't happen to you because you do know what is the correct understanding of how the liquidity works, right? So just to conclude, double bottoms or double tops work not because price respects them, but because institutions use them to gather liquidity before the real moves, okay? And this is a small disclaimer I want to say. I'm not saying that not all the patterns works. There are patterns that do work properly, but they do work because the trader, I mean you, already know the correct direction of the market. And once you know that direction of the market, you can actually work with those patterns. And you have back testing those patterns that much in a really clear scenarios that you made them work. That's the difference. Okay, that's the difference. You made them work in the past. Now you can make them work in the present and in the future. And that's why I'm pretty sure there are some profitable professional traders who works with patterns that probably I'm saying at this moment they do not work, but they do work, but not because the pattern do not work. It's because they know when the pattern works, and that's a whole complete thing. It's so different. If we are just executing orders just because in the market, believe me, that will cost us a lot of pain and I wouldn't say tears, but I would say it would cost us a lot, right? Excellent. Now that we have seen the three most common patterns, let's see in a bullish trend how these patterns are created and how you can spot them, and then how to avoid them, okay? The idea is that we're gonna recognize how they work in a real market scenario, okay? So let's see more examples of this. Perfect. Now we're gonna use the Bitcoin as an example, correct? I have already defined my range beginning and range ending right here. If you do not know what I'm talking about with the range beginning and range ending, I kindly suggest you to watch my previous video in which I explained the simple macro structure. There are bullish examples, bearish examples, plenty of content for you to study, right? So now I have already my range marked right here, which is the one I'm gonna work with. And I don't know, I'm gonna give you just 3 seconds. In this bullish range, I have the 3 examples of the 3 patterns of liquidity I just have taught you today. Have you already spot them? Let's go. Let's break down each one little by little. So I was in a 4 hours range, but I'm gonna reduce or decrease it to a 1 hour time frame so we can see it even clearer, right? Now, but before doing that, look, I just gonna point them out. This is an example of what? Double bottom. This is an example of equal highs, equal lows, right here. You can see it, right? Now, this is an example of double bottom and double top and double bottom pattern, right? And it's missing the trend line, right? We're gonna see it in an hour. But let's start with the first one. Wait, boom. The first one is, here is the trend line from this to this. But let's start with the first one, which was the equal highs, equal lows, okay? So we are in a bullish trend in 4 hours time frame, correct? Now, look at the next. Here, oh, this is also, here we could see, yeah, here we could see the first high that people would say, okay, it's a normal high, price would respect it. Then when you see the second high, which is touch, people start saying, oh my gosh, this is a double bottom, double top opportunity. Let's execute an order right there. People start executing orders. And then when the third and the second candle week here, people are start believing, oh gosh, this is going down, right? Bitcoin is going down right here. So people are putting orders here to sell, selling orders, right? Now, this is how the sellers, this is how sellers thinks, okay? Now, people who are buying Bitcoin see this first low. They say, okay, this low is normal. They see the second low and they say, okay, this may have a reaction. And then they see the second one and they say, oh gosh, I think this is a bullish pattern, right? And they start buying, right? And in this case, who do you think has the most probability to win on this bet? Because if you're executing trading orders this way, it's a betting, right? You're just betting at the market, right? Definitely people who are buying will have more chances to win this bet. Why? Because they're in a bullish trend, as simple as that, right? So sellers lose their bet because the price had a reaction, takes them out with this candle of the body, the one I'm pointing out here, and then boom, with the body of the candle, they're out. So this is the first pattern of liquidity. And also, if you go to in a lower time frame, you could see it even clearer sorry, because you will see a consolidation. This is a small consolidation, right? In 1 hour is huge to wait for some people, right? But in 15 minutes, there's even more liquidity or more patterns there in the market, right? I'm just gonna put it just to see for you to see it. So in 1 hour, it was a consolidation or an equal highs pattern. But in 15 minutes, because the time frame is smaller, you could see that this changed, the pattern changed. Now it's a triple bottom, or sorry, triple top pattern. One, two, third touch, fourth touch, and then you're out, right? The perspective changes a lot when you change the time frame. That's why selecting a proper time frame is key for you to understand this. Also in 50 minutes, here is a small consolidation pattern as well. Look, here it is. Equal high, equal high, equal high, and a small liquidity pool right here. And there is an equal low, equal low, equal low. So even this is clear for the sake of the examples, right? So people same amount of people buying, same amount of people selling. But in this case, it took the liquidity with these candles. These three candles you see right here took the liquidity of the stop losses of the people who were buying here. And then, because people were assuming that there was a bullish trend, took all the liquidity, people changed their mind and start selling, and then boom, it happens. So this is the first explanation of the first pattern, correct? Excellent. So equal highs, equal lows. Second pattern I'm going to explain to you is the trend line, correct? So trend lines are evident to see, as we have explained it before. So the first trend line example is here. So we're going to take as a reference point this low, the second touch that people are expecting to do the price. Oh, this is beautiful. This is beautiful for the sake of this example. Why is this beautiful? I'm gonna let you know in a minute, right? All this trend line is liquidity. People are watching this as the third point, the third pivot point. So they will say, gosh, this is where we're gonna buy, we're gonna all in on this, right? People start putting orders here. And they put a generous stop loss, right? Let's say they put the stop loss below the low. Perfect. It's all right. So as I said before, trend lines are made for what? To accumulate money in the market, right? We can spot liquidity right here. And now we're gonna see our second pattern, or third pattern was a double top. Can you see the double top, my friends? Yeah, here it is. Look, this low is the first point, or the first pivot point, and then we have the second. So people are actually doing the next, and this is what I said, it was beautiful. There is a confluence of the two patterns. So if these two patterns combine themselves, it means that the probability of the setup will be even better, or even harder, or even higher, right? So they double what they were intended to risk at the very beginning. And look how the market is. It's not against you, it's just how the market is. Some candles towards the direction that you're expecting, you're putting more orders, you bear this down movement, you say, whew, okay, we're good. Oh my gosh, there's no stop loss. We're still buying. The price can recover a little bit. Let's do the next. Let's put some pips more of stop loss in order to cover the loss, or just give a little bit of space for the price to move. That's what you say to yourself in order not to hurt your ego, right? And accept that probably you're making a mistake, and not just that, because you're double down your order. So probably there's more that there is more money on the table that you actually can cover, or you want to cover, right? Or you accept to cover. Let's see what happens. All right, you're out. You're out, my friend. You say, holy shit. Now I have to recover the money just lost, because it's impossible. I cannot lose. I mean, I am a professional trader. I want to be a professional one, right? So this is a break of structure. Definitely the price will pushing down. I'm gonna put an order here because I need to recover at least the money I just lose. Does it ring a bell? Have you ever spoke like that? Okay, I love it though because of you. I love it because of me, of my previous me, of my old version. Oh my gosh. Look at the next. Okay, I'm recovering. Oh, holy moly, oh my gosh. Okay, now I'm gonna recover it. But shit, you're out. And if you keep buying, selling without a real pattern to follow, you're just liquidity. If you don't know what you're doing, you're just liquidity in the market. All your money will be vanished in a second because you're not able to control yourself. And this is it, my friends. In today's lesson, we just have covered How to spot the three most common patterns of liquidity creation, which was equal highs, equal lows, also known as a consolidation, trend lines, and double tops and double bottoms. In this case, double bottoms because we're in a bullish trend. Now that you know what not to do, my piece of advice is go to the market, your favorite pair. It could be Bitcoin, the SP 100, they use 30, GBP whatever, and now try to find this type of scenarios in which the liquidities, for example, the equal low is broken, when the trend lines are broken, when the double top and double bottoms do not work, and your mind start being trained and see those scenarios. And I guarantee you, once you train this enough time, you will face the and you spoke enough to the market, you will see, you will, because you're executing orders and you want to be a professional trader, definitely you will be again in the market watching it again, and then you will see a scenario which you have already seen in the past. Now your brain has learned, and he says, "All right, this time in this time I'm not gonna put the double size here. Probably just put one order, or I will wait for the price to make a movement, or probably I will watch Manuel's video or in Smart Habits FX, and then I will learn how to execute proper orders, which is my piece of advice, right? And this is it, okay? And then you just start learning. But this is a beautiful process, my friends. Please do not skip that part of doing the back testing. Do at least 10 examples of equal equal highs or liquidity pools, 10 examples of trend lines, and 10 examples of double bottoms of double tops. Remember that the trend line is very important. If it is a bullish example, you're gonna find, or you're gonna try to find double tops, double bottoms that fails, okay? And if it is a bearish trend, which is I'm gonna put a next video in the next video, the same patterns within a bullish trend, in a bearish trend, it will be a double top, okay? Perfect. And if you want, write me a comment there. Put your scenarios, your questions down there in the comment box. And I'm so happy and glad to teach you in this lesson. So hope you have learned enough. See you in the next class.